Uber is reporting earnings Tuesday, 4th November before the market opens. The stock is up 53% year to date. So let's see if this is a good opportunity to buy the stock by looking at the fundamentals and running a discounted cash flow model to estimate the stock's intrinsic value and potential future returns. Starting with their financials, Uber's revenue has seen impressive growth over the past decade, growing from $3.8 billion to $47 billion today. And analysts are expecting this growth trend to continue, as they are expecting Uber to make $52 billion this year and grow to $82.6 billion by 2029. I agree with this positive outlook because Uber has multiple catalysts ahead. They just teamed up with NVIDIA to develop driverless car technology. Uber will begin scaling its global autonomous fleet starting in 2027, targeting 100,000 vehicles and supported by a joint AI data factory built on the NVIDIA Cosmos platform. Driverless technology could be a major upside, since one of Uber's largest costs is drivers. Looking at revenue by segment, Uber is growing across the board: mobility, delivery, and freight. And looking at revenue by geography, we can see that they are growing in the US, Canada, Europe, Middle East, Africa, Asia Pacific, and Latin America. So basically, Uber is known throughout the whole world and they still have a lot of room to grow, especially in underdeveloped areas. Regarding profitability, Uber turned profitable a couple of years ago, and they are currently making $12.6 billion in net income. They are generating less in free cash flow as it is currently at $8.5 billion. Moreover, Uber has great margins, with gross margin being at 33%, profit margin at 26%, and free cash flow margin at 18%. And analysts are expecting profit to continue to grow as well. In terms of EPS, they expect Uber to make $2.98 per share this year to $4.60 per share by 2029. Then, in order to calculate the intrinsic value of the company and potential future returns, I used my Google Sheet. I did a 7-year analysis with low, middle, and high assumptions, and as you can see, the intrinsic value according to my low assumptions is $86 per share, middle $133 and high $198. And because the stock is currently trading at $96 per share, this means that if my low assumptions occur, you would get a 7.8% annual return on your money, middle 15.8 and high 23.5, which are great returns. As far as my assumptions, I assume Google grows revenue between 7 and 13% annually for the next 7 years. They average a profit margin and free cash flow margin between 20 and 28%, and I assign the PM price to free cash flow at the end of the 7 years of 16, 18, and 20. But if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. Moreover, Uber is trading at a PE of 16 and the price to free cash flow of 23. So we can conclude that Uber's valuation looks attractive, especially for a company to have this much revenue growth. Another positive is that they have an excellent balance sheet with $7 billion in cash and 12 in debt, which is very little for a company that has a market cap of $200 billion. In conclusion, I believe Uber is a fantastic company with amazing fundamental that still has a lot of room for growth. The valuation also looks quite attractive, as we have seen on the spreadsheet and the ratios. However, because the market is so overvalued at the moment, I am being extremely picky with the stocks that I'm buying, and for that reason, I am going to wait for a better entry point. Lastly, if you want a discount on stockanalysis.com, the best site I found for stock data, grab my code in the description. I hope you found this video valuable. Let me know what you think about Uber stock in the comments, and I'll see you in the next one.